All right, let's dive right in. Today we're basically becoming detectives. We're on the hunt for the biggest players in the financial markets, the institutions they call smart money. And our guide for this whole thing? A popular strategy known as ICT trading. So let's get started.
You ever have one of those trades, it's going perfectly, you're in the green, and then, bam, the market just whips around, stops you out to the exact tick, and then continues right in the direction you predicted. It feels personal, doesn't it? Well, it's not random. There's a reason for those moves, and we're going to figure out why.
So here's the core idea, and it's a real game changer. Most retail traders, that's probably you and me, are like little fish swimming against this massive current created by giant banks and hedge funds. The whole point of ICT, Inner Circle Trader, is to stop fighting that current and instead learn how to spot it and ride the wave with them.
So here's our game plan. First, we'll nail down what ICT even is. Then we'll go on the hunt for liquidity. That's the motive behind all their moves. We'll look at how they operate using premium and discount zones, find the actual evidence they leave behind on the charts, and finally, we'll pinpoint the exact source of their moves with something called order blocks.
Okay, let's open the case file. First things first, what are we actually talking about with ICT trading, and who or what is this smart money?
So ICT stands for Inner Circle Trader. It's a collection of trading concepts developed by a guy named Michael Huddleston. And here's the thing, it's all about reading the raw price chart. No fancy indicators, no clutter. The entire philosophy is built on understanding the why behind the market's moves from the perspective of the giant institutions that are actually in control.
You know, every good detective story needs a motive. And in the markets, 99% of the time, that motive is something called liquidity. So what on earth is it, and where do we find it? Just think of liquidity as the gasoline for the market's engine. It's not complicated, it's just a huge cluster of orders. We're talking about stop losses from traders who are already in a trade and entry orders from people waiting to get in. Now, smart money needs to tap into these pools to fill their massive orders, and they know exactly where everyone places them, right above recent highs and right below recent lows.
And this shows the two types perfectly. Over on the left, you've got buy-side liquidity chilling just above a recent high. That's where all the short sellers put their stop losses. On the right, you have sell-side liquidity waiting just below a low. Same idea, just a giant pool of sell orders.
And look at this on a real chart. You can almost see it happen. Every time the market creates a clear high or a clear low, it's like painting a target on the chart. Price is drawn to these spots like a magnet, because that's where the fuel is. Smart money will literally push the price there just to trigger all those orders.
Okay, so we've got their motive, liquidity. Now let's talk about their method. Smart money, at the end of the day, is a business. And what does every business want to do? Buy low and sell high. It's that simple.
And how we figure out what's low and what's high is incredibly easy. You just take a clear move in the market from a low point to a high point, and you split it right down the middle at the 50% line. Everything above that line, that's your premium or expensive zone. Everything below it is the discount or cheap zone. And this is absolutely crucial. The big institutions, they're looking to buy when the price is on sale, when it's in a discount. And they are looking to sell when the price is expensive, when it's in a premium. They are not chasing price way up at the top to buy. They're way smarter than that.
Now we can get even more precise. Within those discount and premium zones, there's a little sweet spot called the optimal trade entry, or OTE. It just uses a Fibonacci tool, which you've probably seen, to highlight a specific zone, usually between the 62 and 79% levels. When price pulls back into that little OTE pocket, it's considered a super high probability area to look for a trade.
All right, so we've got the motive and the method. Now it's time to dust for prints. See, when smart money makes a move, it's so big and so fast, they can't help but leave behind very distinct footprints on the chart.
And that footprint is called a fair value gap, or FVG. All it is a three-candle pattern. When price just explodes in one direction, it leaves a literal gap, an imbalance between the wick of the first candle and the wick of the third. It's a dead giveaway that one side of the market, buyers or sellers, was just in total, overwhelming control.
And here they are. On the left, that's a bullish FVG. They call it a BZ. That forms when price rips to the upside. And on the right, you guessed it, a bearish FVG, or SIBI. You can see they're just mirror images of each other. These gaps are basically inefficiencies left in the market.
So here's why this matters. The market hates a vacuum. It wants to be efficient. And when price moves so fast that it leaves behind these imbalances, it has a very, very high chance of coming back to fill in that gap to rebalance the price. This means these fair value gaps become powerful magnets for price, and they often act as incredible support or resistance levels.
We've got the motive, the method, and the footprints. Now we're tracing it all back to the source, the point of origin. This is probably the most powerful piece of evidence in the entire ICT playbook. And that's the order block. It's the very last candle before a huge, explosive move. To be specific, it's the last down candle before a big rally or the last up candle before a big drop, especially if that big move just grabbed a pool of liquidity and broke a previous high or low. Let's break this down. For a bullish order block, you see price dips down first, grabs that sell-side liquidity we talked about, right? Then it rockets up, breaking the previous high. That last down candle before the launch, that's your order block. And the bearish setup is just the exact opposite.
Now, not all order blocks are the same. The really good ones, the high probability ones we're hunting for, show up at major turning points in the market, right after grabbing liquidity. The ones that just kind of form in the middle of a move, yeah, they're much less reliable.
And this is where it all comes together. Just like with those fair value gaps, price loves to come back and revisit these order blocks. When price returns to test that specific candle, it can offer an insanely precise, high-probability entry to hop on board the move that smart money just started.
So look, if you want to sum it all up, this quote really nails it. ICT isn't some magic system. It's a way of thinking. It's about looking at a chart and understanding the story it's telling, the story of what the big institutions are doing.
So now you have the basic decoder ring. You can start to spot the motive, the method, and the evidence that smart money leaves behind. Their footprints are all over the charts. The only question left is, are you going to follow them?